Kia ora and welcome to Shared Lunch, brought to you by Sharesies. My name is Helen Mattison and today we talk about the US markets. But don't worry, this episode is not all about the election. In particular, we'll discuss the Vanguard S&P 500 ETF index. From near Philadelphia, I'm joined by David Sharp, who is a senior ETF capital market specialist at Vanguard. Vanguard being one of the largest and probably most well-known fund managers in the world. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
So good evening, David. Thanks for being with us. You're just out of Philadelphia, is that right?
Yeah, that's right, Helen. Thanks for having me. Yeah, we are just west of Philadelphia, about 45 minutes west in Pennsylvania.
In terms of elections, typically when I ask commentators about whether or not they move markets, they pretty much say, look, they've factored it all in. But I do wonder if this one is a bit different because we've had a few kind of things to think about. For example, I know Robinhood, the US trading platform in the US, has given the opportunity for people to buy event derivatives where you can bet each way on which who will win. You've also had Donald Trump's social media platform go sky high in terms of its value, and also have seen that with the markets, crypto and some of the small cap sort of stocks have supposedly done well because we have this election fever. But I was keen to get your perspective working in the capital markets in the US to see whether or not you've noticed anything different.
Yeah, I would say again, it has been a noisy election season, but what we look at through our investment strategy research group, where we look at just researching over, time period as different administrations are in office, we find that presidential elections can be, although hugely consequential on the direction of public policies, they often aren't a good guide for, dictating your investment decisions. Certainly, as you mentioned, there is, sometimes particular sectors that could outperform others. We did see, solar energy trading at a higher amount today in the U.S. market on Monday. That could be an indication that maybe the market is seeing, a potential for a Harris victory. But last week we saw, Bitcoin hitting new highs, which were, I think generated somewhat by some of what the Trump administration has said that a potential Trump administration has said that they would look to do in that space. So it's really going back and forth. It is, a tight market. And when we look back to research dating back to all the way back to 1860, we really find no statistical relationship between the performance of a 60-40 portfolio in presidential election or non-election years. So, what we've really encouraged clients over the last couple of weeks as we build up to this election is to really just try to tune out some of that noise, really stick to your long-term investment plan and not make big changes based on policy proposals or election results, because we just don't know. What we know for sure is the market will go up and the market will go down. But outside of that, all the rest is purely speculation.
So that portfolio that you're talking about over that long period from 1860, I think, till about 2022, because I did read that article put out by Vanguard, was that a portfolio with a 60% shares, 40% bonds? Was that right?
That's right. Yep, correct.
Okay, so is that more typical for now, though, something like that? Or was that sort of more traditionally what people would have had as a portfolio?
So we still think that the 60-40 portfolio has value for the right investor. Certainly it has to be, kind of related to what your investment needs are, what your risk tolerance is, where you are in your investment journey. For younger folks that are just getting started in their retirement plan, then 40% bond allocation would certainly be too much in our viewpoint. But the 60-40 ends up being kind of a good dictation for where institutions can find the right balance, even more so than retail. And it just tends to be, a portfolio that gives you a little bit more neutral risk relative to, maybe somewhat muted performance by having that bond allocation. We've seen in most years, 60-40 ends up being a pretty productive portfolio to have. There are some years that is off. 2022 with the raising rate environment, we did see stocks be depressed in value and bonds get depressed in value the same year, which is rare. You usually see those correlated in opposite directions. So for that to occur in 2022 was kind of more anomalous than it was, what we'd expect for the future. And it really just was the speed of the rates that were taking place that affected both sides of the investment landscape.
So David, let's roll back to what Vanguard does. I think it was established back in 1975, so nearly 50 years. You're sort of known as a passive index manager, low cost being a big part of that. Give us an idea of what you're doing today, and has that changed over that period?
Yeah, you were exactly right. We were founded in 1975, so we're coming up on our 50-year anniversary next May, which we're looking forward to. We actually just passed in September our 50 years of incorporation, so our official incorporation before we launched that following May. But the way that we often will describe ourselves is just one of the world's largest and hopefully most respected investment management companies. We offer a lot of different investments, advice, retirement services, insights to individuals, institutions, and financial professionals through thought leadership, through other research avenues. And we really are a worldwide firm. Obviously, we're known for our U.S. presence, but we do manage over $10 trillion, $10 trillion US dollars assets under management. And we have more than 50 million clients, and it's really all around the world. Even our ETF specifically, we have domiciled in the U.S., in Canada, in Mexico, in Europe, and Australia. So even in our ETF realm specifically, we are broadly diversified. And I think, as you mentioned, we are known to be an index shop. That is what we're most famous for, launching the first retail investment fund that followed an index, which we're certainly going to talk more about in the next half hour to an hour here. But what I think is surprising to a lot of folks is we have $1.8 trillion in active management as well. We do see ourselves as having an active prowess, and we do sub-advise a lot of our equity to active managers, but we do in-house fixed income active management. And we are really proud of that active franchise that we have within fixed income because it is, a bit unique, and that unique investor-owned structure that we have where our clients own our funds and the funds own the company allow us to really operate at cost and keep our costs very low. In our ETF lineup in the U.S., no product has an expense ratio over 22 basis points. And, they're as low as for our 500 index fund VOO, or what we affectionately call VOO on the desk, we are down to just 3 basis points for that product.
Let's unpack what the VOO is for a start, because if we're tracking that index and it being, I think, one of your most famous, what's it all about?
It's a great question. And, I think when we look at the 500 index that we have in our ETF VOO or VOO, as I mentioned earlier, it really dates back to August 31st in 1976 in the mutual fund wrapper, or that open-ended wrapper. So that ETF really is a share class of that portfolio that is almost 50 years old now, that tracks the S&P 500 index and buys all the 500 companies within the S&P 500 at the weights within the index. So that fund from 1976 all the way to 2010 was just a open-ended fund and index fund, mutual fund that you couldn't buy on exchange. On September 7th of 2010, we launched a share class of that 500 index, and that was our ETF VOO. So that is a unique style that we have at Vanguard. That is a patented approach that we had with our first ETF we launched, our total stock market ETF in 2001. That we actually had patented, and no one else could do this multi-share class strategy in ETFs until our patent expired last May, and it still is awaiting other approvals. So what the great advantage that actually provides us to have an ETF share class is that we got instant scale in that product, the economies of scale that allows us to keep our costs very low, and it allows us to keep our tracking very low as well, because the fund is so large across all share classes, over $1 trillion in this fund in total assets, that the ETF was able to basically get that history of getting exposure there in that fund at a really cheap cost with low tracking right out of the gate in 2010. So what we've seen in that time period since that launch now about 14 years ago is just incredible growth on the product, especially over the last few years. The cash flows that have entered that product as the mega cap and large cap companies have performed so well in the US. We've seen VOO actually lead flows this year with close to almost $86 billion in flows so far this year, which has put us up as the close to the second largest ETF in the world now, only behind SPY. And, we are, certainly not focused on flows, but we're proud to see that adoption of our products really, showing a testament to that low cost that we try to create within that product.
One thing must be said, though, about any market, but particularly the US markets in recent times, is the volatility. There's a fair bit. It seems to happen pretty much all the time. So I suppose for investors thinking about the VOO, if you like, they would really have to be able to stomach volatility, as it were.
Yeah, certainly, as the S&P goes, this product will go. So, there's certainly been, some level of volatility in the market, that has ramped up a little bit as we go into this election cycle that we spoke about earlier. The good news is, again, though, even though it's just 500 companies of around 3,700 public companies in the U.S., it is the 500 largest. And, there is some level of stability that does come with that. I believe relative to some of the lower market capitalizations that naturally have a little bit higher volatility profile, it's still something that exists. It is still the stock market. The stock market still will go up and go down, and the 500 index no different. So there is absolutely that, potential of volatility in the market, and especially during times of stress in the markets, which hopefully we don't see in the near term.
What is the weighting at the moment for the VOO or roundabout for the tech stocks? It used to be almost up to a third with things like the Magnificent Seven. So we're talking like Alphabet, Tesla, Microsoft and the like.
Yeah, it is. The portfolio is about 31.7% technology at this point, and it is driven by those Mag 7. When you look at the Mag 7 alone, they make up, a very large percentage of the portfolio. About 28% of the S&P 500 is actually in those Mag 7. That's how strong their performance has been over the last, close to 2 years now. Driven heavily by, NVIDIA as the leader there, as that's come up that board. So, when we look at it, the second largest, holding there is still financials, but it's all the way to 12.9%. So, one argument that could be made, to your point, is that although it's diversified across all the major sectors, it is heavily weighted to technology at this time.
And some of the other big sectors would be banking, and is healthcare perhaps another? I'm just trying to think. Yes, it is diversified. There's 500 companies, but actually there's all sorts of good and bad in there, isn't there, in terms of depending on your value when you're investing?
Yeah, certainly, it's broadly the 500, largest market cap companies in the U.S. Sometimes there is, naturally some additions and deletions around the bottom of that, but for the most part, it is that. So you do get, over 79% of the portfolio has a market cap that's greater than 72 billion. So there's some really large companies in that portfolio, but the diversification does change across sectors as certain sentiment comes into the market. At times, we look at last year, and energy was actually one of the leading sectors last year, but it still makes up only about 3.3% of the portfolio. But it actually had a really good year last year at close to a 35% return. So you really have, when you map it out over time, what sector bubbles up to the top tends to rotate at some level of frequency. It's just been a strong couple of years for technology, frankly.
One thing I wondered with Vanguard, earlier in the year, you said you wouldn't be doing cryptocurrencies. I think that was when the Securities Exchange Commission approved Bitcoin as ETFs. There was a lot of interest in that, and we've seen markets sort of go up even with this election fever, as I said before. Is that still something that you are not going to be going into, or you're thinking more about it as perhaps it becomes more, if you like, mainstream?
Yeah, I would say, I wouldn't speculate too much on, if the future would change our view, just because changing market conditions can certainly, change our position. But at the current time, it still stays stable in the fact that we don't plan to launch a Bitcoin ETF. And it's really just related directly to our viewpoint on the importance of intrinsic value in a security, and our fear that might be tougher to determine within Bitcoin or cryptocurrencies relative to high quality stocks or the bond market, quality within the bond market. So that's one of the challenges when we look at that asset class. The other one is just the volatility that is naturally inherent there is much greater. We have a retail-focused client base that we want to make sure is thoughtful for long-term investing and is, considering, where their goals are for the long term is paramount to us. And we just, do have some fear that the volatility inherent in that product could send some of our clients kind of off of that trail. So we are a little bit tepid and, relative to some of our issuer partners to bring a product to market for those reasons. But I am not in the case to say, I would definitely say never, but it is something that isn't high on our list at the current time.
A lot of Sharesies investors tend to hold their ETFs, but there is a number too who like to buy and sell. Have you got any kind of sort of tips, I suppose you'd say, for thinking about timing with ETFs? Because obviously they're quite different to a managed fund as such.
Yeah, I would say, we are, certainly believe the buy and hold strategy is really important because any sales and subsequent buys, besides the difficulty of actually market timing, which we've proven, over time, it's just if you do try to market time, the challenge to do that is great. What we tend to see is, low cost, long-term investing usually will have a better payoff than more frequent changes in different market conditions. The other part of that is just the cost that you incur. The more you rebalance, the more you have to pay that spread to be able to buy and sell the security. That will distract from some of your returns and make some of those returns harder to accomplish the same way you would in a buy and hold. So we really, preach the idea of having large diversified portfolios that give you exposure to many parts of the market and then holding on to those for a longer period of time and be thoughtful of cost. That's thoughtful of cost when it relates to expense ratios is very explicit, how much you pay. Our founder has a great quote, Jack Bogle, that says, in investing, you get exactly what you don't pay for. So that is, really at the heart of our strategy to give you, if you have 100 basis points of return in the S&P 500, if we only charge you 3 basis points, you keep 97 basis points of that, and that compounds over time. We think that's really important for clients to achieve their investment success over the long run. What
about in terms of sort of assessing your portfolio? Yes, to hold set and forget, if you like, over a period of time. How often would you suggest people need to have a look about maybe rebalancing?
Yeah, rebalancing is still important for sure. What your target allocation is, and determining that target allocation up front allows you to ensure that you're rebalancing back to that target allocation. So we do say that, quarterly is a good opportunity to kind of take a look and see how far away you are from your target allocation. If it's only a percentage or two, that could quickly go back the other way. What we really like to see before you would spend the potential transaction costs to rebalance that would be to start to stray about 5% away from your target allocation at that point, which if you're reviewing on a quarterly basis allows you to tie that back in and ensure that if equities had the run they had this year relative to bonds being a bit flat, and now your equity position is greater than your target allocation, then it is a good idea to rebalance that back and stay focused on that long-term strategic allocation that you hope to have in your portfolio.
One of the criticisms often leveled at the US markets is that they're topping out. They're just keeping on going and all of a sudden there's going to be a crash and people are going to burn as a result. I mean, what do you sort of say to investors in terms of keeping that longer term view, knowing that markets, as you said before, go up and go down?
Yeah, it's important to just think of that long-term time horizon. If we look at 2022, the 60-40 portfolio we mentioned earlier had one of its worst years since 1930s because both stocks and bonds were down together, which is rare. So, that was a clear example of a time where people were feeling a little bit of the pain of the market and having that drawdown. But those that stayed in it, that return we've seen since 2022 is almost 45% in the S&P 500. And in a 60-40 portfolio would be muted a bit to that, but it's still, that growth that you've had in that time period by just staying the course and staying focused on your long-term plan and not reacting to short-term market events, even if they aren't, it's not easy to see on your portfolio when the number goes down, but it's really important. And we've showcased over time this, what happens when you get out of the market when the time is in stress and you miss that, return to positive returns. What that does over the long-term investment because of the impact of compounding is quite great. So we really try to reinforce to tune out the noise that's in the market and really just be focused on if your plan is 20 years from now, your portfolio doesn't need a lot of change right now to be able to achieve the goals that you have for your long-term investment returns.
What would you say to New Zealand investors who are thinking for the first time to invest in the US markets? They might have played around a little bit with individual stocks, but perhaps now they're thinking exchange-traded funds is probably an easier, cheaper, maybe safer way to go.
Yeah, I think that we do, stress the importance of diversification, and that is something the ETF gives you. You can trade it like a stock within the market, but it still gives you the broad exposure of what the underlying portfolio is made up of. And in this case, it's the 500, largest companies in the U.S. So that diversification that you get over choosing one single stock really is an important risk mitigation tool. When we look at securities over time, the number one security in the S&P 500 in 2005, in 1995, and 1985, it's different every time you look because, markets are going to, there's just different situations for different securities that are going to increase their value or decrease. So having that broad exposure instead of maybe even looking at, everybody looks at, we just take NVIDIA as an example because of the great ride that it's had. Everybody wants to have the number one stock in the market, but NVIDIA won't always be the number one stock in the market. And how are you diversified when there is a drawdown there? If the valuation might get too high, the rest of the portfolio helps to kind of pick that up. So we really just stress that diversification. We think this gives a great opportunity to get that in a wrapper that, again, is really low cost and easy to access.
David, there's a phrase online where people say VOO and chill. Just wondering what your take on that is.
Yeah, it's a funny phrase that, I think we are starting to see fall into the lexicon a little bit more. And it's really, to me, it resonates a lot of what I just mentioned. It's, you don't have to get complicated in the market. You don't have to be chasing returns or looking for opportunities to maybe find the next hot product. Just buy VOO, buy VOO and chill. Just, kind of sit on that, continue to invest it as you have new monies go into it. And because what we see is over the course of, long dated periods, say 50 years is the longest, only about 2% of active managers can beat the index. So instead of chasing some of those returns from that active management or some of those strategies, buying the index, that whole index, and just sitting it out and just waiting for the long term, or VOO and chill, as can be said, is really we think a really great strategy to just get those long-term investment returns that we talked about.
Thanks for your insights today, David, and thanks to everyone else for joining in too. You can watch Shared Lunch on YouTube or follow us on your favourite podcast app. Leave us a rating and a comment about what you'd like to hear next. Mā te wā.